My name's Tom Elliott and welcome to another financial markets update for Hodges Real Estate. Well, until recently I've been pretty positive about things. I've got to say though, in the last 4 or 5 weeks, there's been quite a bit of bad news coming out there. Now, firstly, the budget. It's fair to say that Joe Hockey's first budget was also one of the more unpopular ones of modern times. Whether it was the deficit levy, the petrol tax, or any of the other things about the budget that really grabbed people's attention, for example, also the $7 co-payment fee for going to the doctor, everybody was out criticising it. And this hasn't helped consumer confidence. Retailers say that people aren't buying very much. They also blame the relatively warm start to winter for that as well. But as a result, consumer confidence is down. Now, having said that, though, however, there is a takeover on the books for David Jones by South African retailer Woolworths. Solomon Lew is also getting involved. So even though people aren't shopping in the shops, at the big end of town, companies still want to buy each other. When it comes to housing data, RP Data, which also works with Rismark, has come out and said that in May, Australian house prices fell almost 2%. They said 1.9% was the exact size of the fall. And indeed, Melbourne really led the charge. They say that according to their data, Melbourne house prices were down 3.6%. Despite this, unemployment very steady, 5.8%. And in fact, here in Victoria, unemployment has actually fallen from 6.4% earlier in the year to just 6.2% now. And that is unambiguously good news. The only bad bit of news when it comes to unemployment is that the participation rate has fallen very slightly. Still, the participation rate is largely steady around about 65%. Now, New Zealand, I find myself these days constantly referring to New Zealand. Their economy is doing better than ours. Their budget is already back in surplus. They don't have several layers of government to deal with, just one, what seems to me, a very competent layer of government. But New Zealand's economy is doing so well that its interest rates have gone up again. In fact, the New Zealand cash rate was recently increased from 3 to 3.25%. Now, I've mentioned this before, but I'll say again, Australian cash rates historically have tended to follow New Zealand ones. Right now, the New Zealand cash rate is 0.75% higher than the Australian one, and this suggests that at some stage soon the Reserve Bank will follow suit. Now, the Reserve Bank has sat in its hands for quite a long time now. Our interest rate's at 2.5%. I think if there is going to be a move soon, it probably will be up, but I think the most likely outcome is that the Reserve Bank will continue to do nothing. Australia's economy right now is a bit like the porridge in Goldilocks. Not too hot, not too cold, but just right. It's not ideal, but it's not really worth the Reserve Bank's time changing interest rates right now. The only way interest rates will fall in Australia is if there is some global calamity, and hopefully that won't happen. Now, speaking of calamities, we've got all sorts of bad news coming out from Iraq. Now, we pulled our forces out of Iraq back in 2011, but since that time, an offshoot of Al-Qaeda called the Islamic State of Iraq and Levant, or ISIL, or ISIS it's sometimes called, has been wreaking havoc in that country. They now control roughly a third of the country's territory. There's talk of both Australia and the US putting forces back into Iraq. That would be an unmitigated disaster, and I really don't think it will happen. I think the Americans may launch some airstrikes, but the chance of American and or Australian soldiers going back on the ground there, I hope, is somewhere between Buckley's and none. However, it has unnerved world markets a bit. The share market has been rather volatile of late, and perhaps more importantly for people, the oil price has started to rise. Now, this is good for oil producing countries and companies, but it's very, very bad for consumers because, of course, in our budget that I mentioned before, we've already got a resumption of the indexation of the petrol excise. That will add 1 to 1.25 cents a year to the price of petrol. Some people believe that what's happening in Iraq could add 30% to world oil prices from around about $100 a barrel to 130. The rough rule of thumb is that every US $1 rise in the price of a barrel of oil adds about a cent to petrol prices. So if the oil price goes up $30 a barrel, well, that's 30 cents a litre extra on petrol. That also would not be good for consumer confidence. The iron ore price is another area of concern for us here in Australia. It's fallen below US $90 a tonne, and that's a level it hasn't been down to in almost 2 years. Iron ore is probably our single most important export. The Chinese buy so much of it, and it's done so much for our balance of payments over the past few years. If the iron ore price keeps falling, well, what does that mean for us? Well, it means that the share prices of BHP and Rio could come under some pressure, and many Australians, of course, own BHP and Rio via their super funds. It also means the Australian dollar could fall. Now, this is a bit of a mixed bag. Our dollar needs to be lower if our beleaguered manufacturing sector is to get back on its feet. And I do believe, and I know the RBA thinks this, they would much rather see our dollar down at around 84 cents to 94 cents where it is now. Having said that, the Australian dollar is seen as a model for stability in the Asian region. It is still highly sought after by overseas investors, so the dollar is sort of caught between two competing forces. However, if demand for iron ore keeps falling and if the iron ore price keeps falling as a result, I do think we will start to see our dollar lower at some stage in the fairly near future. But that of course would be good for manufacturing, and it would also be good for overseas property demand here in Australia. Now, anecdotally, the evidence is that Chinese buying for both residential and increasingly commercial real estate here in Melbourne is still very, very strong. And remember, the lower the Australian dollar is, the more money overseas buyers have to play with. So from the perspective of money coming into our property sector, a lower dollar would be a good thing. I do think that the level of Chinese buying in Australia shows absolutely no signs of going away anytime soon. Clearance rates over the past few weeks have been steady at around about 70%. That indicates a balanced market, not a bull market, a balanced market. And I think we're starting to see a fair bit of the heat come out of property prices, at least according to the Rismark RP data that I mentioned earlier. The Victorian population continues to grow. It's 100,000 people a year from both interstate and increasingly from overseas. That provides a consistent growing base for property demand. I mean, all those people have to live somewhere, and a lot of the migrants who come into Victoria are skilled migrants with good jobs who want to buy houses. So that is ultimately a very good long-term factor in our property markets. Look, the budget I think is the big thing that's causing people concern right now. Eventually it will either get negotiated or passed in the Australian Federal Parliament, although I must say Joe Hockey has a very tough job ahead of him. He hasn't had much luck with the current makeup of the Senate. Clive Palmer's Palmer United Party will control the Senate in a few weeks' time, and I don't think Clive Palmer's going to be any pushover either. But one way or another, the budget in a negotiated form will be passed. People will soon forget about it, and fairly soon they'll start thinking about the next one. So there is a bit of bad news around at the moment. It doesn't appear to be affecting the property market too badly right now, and I think the long-term trends of demand from overseas and demand from immigration coming into Australia is very, very good for us here in Victoria. Okay, thanks very much for your company. I'm Tom Elliott. It's been another Financial Markets Update for Hodges Real Estate.